All right, so we are here today with Martina Schrad coming to us from Germany, and we are going to talk about the world of global real estate and investments. And Martina, thank you for being here today. Why don't you just kind of tell everybody a little bit about you and your company, and I'll let you take it from there.
Okay, thanks a lot, Greg, for being with you in this interview today. So my name is Martina Schrad, and I'm a tax partner with Evershed Sutherland in Germany. So Evershed Sutherland is an international lawyers company, and we're advising our clients globally. So basically, I joined last year from an in-house position. So I take not only the academic, but also the practical and hopefully a pragmatic perspective to advise our clients. I'm specialized within the tax field on international tax law, as well as on real estate and investment funds. So that pertains also to the tax efficient structuring and financing. So nowadays, of course, we're not doing anti-avoidance planning, of course, but still specifically on the real estate field, you need to pay attention that you do not pay taxes double or several times. And specifically, you need to monitor tax compliance provisions because these may also trigger penalties and additional payments.
Yeah, so that cross-border taxation can sneak up on you pretty quick.
That's true.
That's true. Yeah. So you and I talked a couple of weeks ago, and you have a brilliant perspective on the world of investments, not just real estate, but in general. And, you know, being in the United States, I get a lot of people from outside the country that want to invest in the United States. But you had an interesting perspective on why the United States may or may not be the best country for investing in real estate right now. So could you talk about that a little bit?
Well, basically, I've been working in-house with the German asset managers. So our investors basically were a number of German savings banks and institutional investors like German pension funds and insurance companies. So first of all, I think one issue is when you're investing as a German institutional investor, from this perspective, currency is an issue. You may have to hedge it, and you may have to consider certain regulatory restrictions as to the currency, because typically the principle is that you need to ensure that the risks you are covering that they are all in the same currency. So that's, of course, something that needs to be considered. Then when it comes to this investment cycles, I think the United States, at least in my last position, they have not been in the focus. So that was still a market where we say, well, we need to see how the real estate markets develop and to get the right point of investing. So currently everyone is looking for core real estate, specifically with these, say, more conservative investors. So it's, well, of course, something which is about pricing, and actually you should not buy it when the price is the highest. So that's basically the point. So we were a little back. However, there are a number of German asset or German-based asset managers which are really specialized on US investments. So specifically in the retail sector, so they have a long-term track record, and so that's basically the situation. So currently the markets are still under high pressure. There's a lot of equity to be spent. However, with the institutional investors, currently the focus will be more within Europe, just to be on the safe side. And I mean, the Corona pandemic still seems to have not a significant impact right now. We have for sure an impact on the rents, which partly are not paid or tenants are not able to pay it. But on the long run, there's still equity to invest. And I think the investors, at least from our client base, they are still well on acquiring properties.
So that's interesting. So you mentioned that the institutional investors in Germany are looking at retail in the United States. Did you say that?
No, not at retail, but I said there are still investments for German retail investors. So basically, private clients which are investing in investment funds holding US real estate.
I see. Okay. So what are from a global perspective, what are the most attractive types of commercial properties in the United States?
Well, I would say it's still depending on, say, the investment strategy of the investment funds. So I am, as I said, I'm more on the tax perspective. So I'm fine on whatever the investment committee decides to invest, which fits best in the strategy. However, say from a conservative approach, this will be for sure core office properties. Currently retail properties are not that much in the focus, and I think this is also due to the current development, which is really weakening the retail sector from my perspective. However, logistics may be still interesting, so we see a strong development on that, even in the prices, because it's absolutely one of the sectors which are really benefiting from the current situation. I think that is still a good investment. So to focus on, say, special properties like hotel will also be difficult currently. So I would assume, but as I said, I'm not the market expert, that there might be still a requirement for office, maybe combined with new concepts of how to use the spaces in the most efficient way. Because there's also, from my perspective, I would expect that there will be a shift in how office properties are used, specifically when the crisis just explicitly showed how much you can really work from home, how remote working really works. I think then we're just looking at sustainable properties, then efficiency as to, say, the equipment in the office properties. This would be something I think of importance in the future. So that's basically my personal view.
Yeah, it's an interesting time for the office and retail sector in the United States. And I imagine, I don't know how that works globally in other societies, but in the United States, there's a big trend with a lot of the, especially the tech companies, moving to a remote work situation, or even moving out into the suburbs and getting out of the cities. At least in the short term, we're starting to see a little bit of that. And a lot of it's going to depend on if we can get this thing under control, get a vaccine or treatment, those types of things, get on the other side of the virus as it's affecting this country. Now, what about the multifamily market? The United States seems to be unique in a global perspective in the types of multifamily properties that we have that you can't find around the world. Big 400 unit, 600 unit garden style apartments, townhouse style apartments versus what you would find in other countries as flats. Do you have any insight on that from some of your investor clients?
Well, basically not too much, because that has not been one of the focus segments. So residential is in the core investment funds, more something which we add to get a certain risk diversification, but typically it depends on the capability of the asset management. So in the companies I worked for, the asset management was clearly focused on commercial real estate, on office, we had specialists for hotel and logistics as well. But residential is still higher maintenance on the asset level management. And so it depends on, there might be funds where you have the external asset managers, which are really experienced with these types of properties, and then it absolutely makes sense. But it depends on how the fund and the management of the fund can be structured in the most efficient way.
Yeah. So from a international investment standpoint, wherever, but let's say I'm coming from the United States and I want to set up shop in the most tax-friendly environment country possible, where would that be? Where would I set up shop to be a global investor for the most advantageous tax standpoint?
Well, I mean, tax structuring is still, or specifically in these times, something which you even do not dare to say that this is tax efficient. It's definitely something which is a little picky currently. I mean, we're in an environment where we have now, at least in Germany, new reporting requirements on how tax structures work, and we have an obligation to report these to the tax offices, and they will see whether this is something which leads to not desired tax avoidance structures or something like this. So specific focus from the tax authorities will be on cross-border investments. So it's currently difficult to say. I mean, we still have differences in the taxation, of course, in the different countries. So there are some countries which really have a very tax favorable rates, like Ireland, which are more holding privileges, or like in the Netherlands, like Luxembourg, which are typical European countries where investments are made from, or where the investment platforms are. Well, when it comes to real estate, well, typically, I think the essential part is just to consider the whole structure. It's typical, one of the typical principles is that the rental income as well as the capital gains will be taxed in the country where the real estate is located. So that's the first principle. So you pay taxes, and typically you should pay attention that this income, this rental income, will not be taxed on a second level, at fund level or at investor level. So that's basically all about double taxation avoiding. So we have a number of so-called double tax treaties, which actually should avoid double taxation and ensure that at least we have one-time taxation. Or they have a kind of tax credit method where you're saying, okay, the rental income will be taxed in the country where the property is located, and the tax paid in this foreign country will be credited against your personal tax liability. So these typically principles apply to real estate, and the same in principle on real estate capital gains when you sell the property at the end of the day. Yeah. So there are still some buts. So it depends on who is the investor and what is his tax status. And then we're starting about, well, how to structure these investments. So it might be appropriate to use leverage by either by third-party debt, and then you need to make sure that these interest payments are deductible. Or on the second level, even the shareholders or the funds or the owners may be able to not invest all of their equity, but just to use the equity by way of internal loans or facilities or whatever. So that might be used also for, well, achieving certain increase in the yield and tax benefits as well.
Yeah, that's interesting. And then you factor the currency exchange into all of that, and then it really gets interesting in terms of where the most efficient place to invest in the world would be right now.
In the world, I could not say it depends on, say, the investment appetite. So, and currently, I just would say from the real estate markets, it's in well, challenging situation, honestly. So there are still, well, the effects and the impacts of the pandemic, which have also, I would say, at least at a later stage, an impact on the real estate market. But if you say, well, the question is, where do you find really profitable properties which have a significant increase in value? And that's basically the best approach, because my personal opinion is you should not make any investments just for tax purposes, because tax-driven structures are always crazy. If you see something, we say, what is this? It's always tax-driven, always. So it's not producing anything which is reasonable. So you can optimize it, but the property itself should be really something where you say, okay, this fits in my investment strategy, just from the risk, from the tenant mix, from the value we can achieve. So what if you say, well, when do we generate properties? I mean, if all already completed properties, which are fully let with A+ tenants, they are quite expensive, of course. So the trend, which I see at least for Europe, is just to access the properties at a very early stage. That means you're just dealing with a project developer and entering into forward deals, and you just take over the property once it's completed and it's fully leased out. So that's something where you just participate in creating a value. And typically, say at least the German funds are investing for a period of at least 10 years. So they are buy and hold strategies. But however, there may be also some opportunistic funds, which are just really a short holding period, developing the property and just selling it. So it's difficult to say, and I would just recommend it makes sense to make a thorough strategy where to invest and consider all the risks related to the country, to the property, to the city you're investing in, and the type of property, that this really fits into a concept. And then in a second step to see, well, how does that work out from a tax perspective, and how could we potentially avoid double taxation or any additional tax risk from reporting, which we need to monitor?
Yeah, that's interesting. In the United States, in this country, most people are thinking of tax first before anything else. And, you know, we have the 1031 exchange where people will exchange like-kind properties, and you'll see some very aggressive cap rates and price points on assets because of that, because somebody's avoiding that capital gains tax, even though it's not as significant as it was, you know, for short-term and long-term gains right now. But it's really interesting, the deals that you see getting done just to avoid that. And then, of course, we have this new Opportunity Zone Fund creation that was created in the United States to shelter capital gains, you know, in this country. So it's really interesting. Now, from the QE that we're seeing go on all around the world right now because of the coronavirus, that has created cap rate compression, specifically in the United States. Are you seeing that globally, the same types of effects that we're seeing in the United States with asset inflation and cap rate compression?
Well, definitely it will have an impact. So we made an analysis of the impact of the pandemic on real estate investment funds at a very early stage. I think like in April this year, shortly after we had the lockdown here in Germany. So basically we were just thinking what will happen at the end of the day to real estate funds. Because if you have a risk diversified portfolio and you have one hotel, okay, it's one-tenth maybe, it might not impact your yield in this year. The second one is, why do we not have the immediate impact is that the business year of most of the funds is deviating from the calendar year. So you just have a really solid yield from 2019. And if you have a business year ending at, say, March 31st, okay, it's 3 months where maybe the rents have been reduced. So it's not that strong impact. So of course, if you have one focus fund, like a shopping center fund, or you have a large amount of shopping centers in your portfolio or hotels, that's the downside. I mean, you're lucky currently if you have a number of logistic properties, so which is really creating a kind of balance at the end of the day. So the additional issues were the German government tried to help really the tenants, and they just said, okay, there's a stop of increasing the rents for at least 6 months, and the landlord cannot terminate the lease agreement during this term, just to really to help all the businesses in keeping up their business during the lockdown. So at the end of the day, even the businesses had access to really cheap loans and subsidies and so on, and except for the landlords. So we just sorted out that at the end of the day, the landlords, where we have a number of institutional investment funds being in such a position, they do not have any security from the government. And so we requested to give certain comfort to these institutional investors, because if you have any amounts as guarantees from the tenant, these typically will only be valid for 2 or 3 months. And so if the business may be closed for a longer period, it's really risk of the landlord. So that was just one issue, that there was a certain bias in how companies are subsidized during the crisis. And the specific feature of these investment funds is that due to regulatory reasons, there's a limitation of taking up leverage. So you can imagine, so if the leverage is limited to 50%, for example, typically this is fully utilized to leverage and increase the yield, of course. But now you have a situation that during the crisis, the tenants did not pay. You have to pay in turn your bank loan financing. And at the end of the day, there might not be sufficient liquidity. And from a regulatory perspective, you're limited and you cannot use it. And that was really the point where we said, you see that these unusual events like a crisis, corona pandemic, that they really impact the laws, because laws are working on the basis that the law is just dealing with a normal market, normal situations where you have book values being lower than the market values, where everything is in due course. But at this stage, when you have really an impact, this is all converted, and it might have been even good to increase the leverage, to increase the liquidity in these funds, to ensure that they can keep up paying their interest on the loans for acquiring the properties. So what we see from, and what might be a lesson learned, is that laws are just dealing with regular situations, and irregular situations may just really question whether law is really correct or not, or leading to the correct results at the end of the day. And we experienced that, at least in Germany, the supervisory authorities were really willing to accept certain really exceptions from these rules. And I think this is also necessary to deal with these crisis situations.
Yeah, the United States, it'll be interesting. So there's talk of potential mark-to-market at the end of the year. So we'll see if that happens. And if that happens, then it'll be really interesting. So a lot of banks are preparing for losses, and they're preparing to just write these assets off versus market them to market and carrying them on the books. So you know, we'll see how that shakes out at the end of the year. But it's very interesting, especially with the CMBS market from a global perspective in terms of what's going on there. And there's a lot of you know, defaults in the pipeline on the CMBS front with these, you know, hotels, office, retail. In this country, those assets have really taken a beating, and there's really not a whole lot you can do about that, you know, unless you get into a negative amortization scenario, sort of like what you're talking about, and allow the values to increase on these assets and just you know, rework those loans. But it's almost impossible in the CMBS market. Now, what about from a taxation standpoint? So with QE worldwide going on, do you feel like we're going to face some sort of a tax situation in the future to kind of help offset some of what the governments and the central banks have done all over the world?
Well, I think the tax development is similar in most of the countries as an effect of the crisis. So what has been definitely extended, or at least is under discussion, to increase the loss set off possibility is to have a kind of loss carryback and carry forward extension where it's not unlimited. It might be also an increase of, well, deductibility of interest, where sometimes you have limitations on that. So I think when it comes to income taxation, I think there's a certain, well, reservation, I would say, just to say, okay, no one is paying taxes at the end of the day. So there are opportunities just to have a postponement of the tax payments, of course, if you're really affected by the crisis. And I think with the real estate, we face the issue, at least in Germany, that we have not been immediately affected as a real estate sector from the crisis. So the real estate landlords or owners have not been entitled to benefit really from, say, any postponements of tax payments and things like this. So it might be different in other countries, but what we noted was that on the subsidies or the measures which have been taken really were focusing at the, say, first level business, but not on the real estate field. And so it's, well, there's a certain, I think I would say, time lag when we see the impact of the crisis on the real estate markets, because the real estate is still immovable. It's an immovable asset. So we are not very quick with what happens. And also there's a time period until we really experience the impact of this crisis, I would say, on the rents and on the payments and on the taxation.
Yeah, it's very different here. As you know, we have the state and then we have the local level of taxation in a lot of parts of the country. And with what's going on, they've lost a significant amount of revenue for sales tax and some property tax with you know, owners not being able to pay. So it'll be really interesting to see how that gets made up. And they're already talking about property tax increases, sales tax potentially increasing, as well as income tax, and some states instituting a state tax that don't even have them to help offset it, because the federal government, it's really interesting. that funding is not going to the local level. It's not helping out on a mass scale cities and states at the local level. Right now, they've been focused more on the markets in general, and keeping the credit markets flowing, keeping the capital markets open, with the bond purchasing and things like that. So it's really interesting what the Fed and the Treasury has done. We've had a little bit of the PPP program here that helped out a little bit, but we've got a big expiration of unemployment insurance benefits this month in this country that has helped prop up a lot of the economy that is potentially getting ready to expire. And, so a lot of that, really the can was kicked down to the road to about this point. So now we're talking about another significant round of QE and things to get us through the end of this year. So it'll be interesting to see, where we go from here with the resurgence globally of the coronavirus. It's very interesting times.
That's a good point, which you mentioned. I mean, also there has been some discussions on really amendments in the German law on real estate tax. So there will be an increase in real estate taxation, but only within the next few years. And also there have been, really heavy discussions on, how to increase real estate transfer tax, specifically on share deals, because you had some opportunities to structure these deals in a quite efficient way so that you could really mitigate the real estate transfer tax. However, this has not been an avoidance structure. This has been really a legal provision which enabled an exemption of share deals, and that has been really a heavy disputed discussion, I must say, and currently it seems that these developments will be postponed also with regard to the crisis. But as I said, this discussion on taxes is always quite linked with the real estate investments, because this is something which is cross-border, and once you have left the border, the German tax authorities still do not have a view what really happens, and there are joint efforts worldwide just to really catch these, say, abusive structures. So to some extent, there might be also a kind of shift in investment structures, where you say, okay, if you are now saving these funds, these taxes, and you do really aggressive tax planning, at the end of the day, if you get a tax audit and you pay twice or 3 times, and you really have issues with this, it may destroy the whole yield at the end of the day. So I think the strategy is, okay, if you pay a reasonable amount of taxes and you really have a very smooth process with the tax audit and all the tax authorities, I think then it's easier on the long run. So it's not a short-term investment, as I said, it's a long-term investment typically. And over the investment term, if you really can just tick the box and say, okay, tax-wise, we're fine, we're compliant. Of course, we're using the opportunities the local tax law offers, but you should not try to really fix it, because, as I said, there's a heavy movement on really trying to reduce these aggressive structures. And at the end of the day, if you have a really brilliant property and you have really a high yield at the end of the day, that's the best return you can have, I think.
Yeah, and that's what I always say. It's about the deal, not about the markets or the climate. It's always about the deal. And the interesting thing in this country, we have an election coming up, as you know. So depending on who ends up in office could really greatly affect our tax code moving forward. So we have a little bit of runway through the end of this year that, investors are fairly certain we're not going to see a lot happen. But going into next year, there could be some very substantial changes depending on the outcome of the elections. So that's really affected a lot of decisions in this country. Because again, in the United States, decisions are largely based on taxation. It's really interesting because when you go international, it's not so much an issue, but in the United States, it's huge. It's huge, and a lot of decisions are made solely based on the tax consequences of the deal.
I mean, I would say maybe I'm not too representative, because I would say saving taxes is a kind of national sport in Germany as well. So I mean, what I'm just saying is, if you have something where you just say, okay, and you can save taxes with this, it sells. Tax sells always.
Right.
That That's my principle, but it doesn't make sense.
It's the icing on the cake. It's I lost your video there.
Yeah, I'm just.
There we go. It's the icing on the cake. It's like do you know opportunity zones in the United States? Have you followed that? So they've created these opportunity zone investments where you can take a capital gain, invest it into an opportunity zone, and you don't pay any tax. And there's a 7-year and a 10-year write-down period on that gain. If you leave it in for 10 years, you never pay any tax on that gain. Or no, it gets written down, but whatever you make on that investment is tax-free from the 10-year investment. So anyways, that largely, so those opportunity zone investments, so if you invest into an opportunity zone project, you get to write down, I believe it's 25% of that gain over a 10-year period, but then everything you make on that investment is tax-free after 10 years. So that's a huge benefit, but the deal still has to make sense. That's just an added bonus, you know, on something like that. So that's kind of the equation there. With what you're talking about. It's just icing on the cake. You can never, the deal has to stand on its own, and then the tax is just the icing on top. But like I said, in this country, a lot of people will overpay just to avoid a tax in a 1031 exchange. It's really interesting. And that's created a lot of cap rate compression in our market on a lot of assets, especially in the multifamily sector, because right now in this country, housing is the #1 asset to own. Single family and multifamily, people have to have a roof over their head. So in an economic meltdown like we've seen, and it hasn't gone as far as it could. So if you added 2009 to what happened now, we would really have what I call economic Armageddon, where the economy of the world would just shut down. We've only lost, what, 20, 30%. You know, we haven't really seen what a real crisis could look like. And this is only temporary. Now, if you add a bank crisis to it, and we had that asset, the collapse in the assets like we saw in 2009, we would really have a problem. But even then, you know, people still need a roof over their head. They still have to have somewhere to live. So housing has proven to be, you know, the safest investment in any economic environment. You know, at the end of the day, even if money is worth nothing, you have something you can trade if you have housing for people. And, you know, if you go back, you know, to, you know, the early days of you know, most of the countries of the world, it was all the landowners, right? Providing housing to farmers and things like that in exchange for work. So it's really interesting.
Absolutely. I mean, taxes is always a kind of incentive. Mm-hmm. And if you do the tax structuring based on, say, the regular taxation principles and really on the standard tax rates, and if the investment makes sense, it's reasonable. So if you have any opportunities to get subsidies like additional write-offs, like a rollover relief, what you exactly mentioned, you take it, but you need to consider it may be withdrawn once the government needs the taxes and needs more income. So that's basically, I think, my leading principle when we do tax structuring, just to really take all the opportunities we have and use the legal measures which are available. But however, just keep in mind the investment should be reasonable. So if it does not make any sense in investing in, say, in any free investment zones, because just you have a specific depreciation rate and it does not fit in the investment strategy, leave it. Or if you say, okay, if I just buy it right now and I have a tax benefit, but I want to sell the property at the end of the day, and there are no buyers available because no one really wants to be there because the infrastructure is not sufficient or whatever, then it doesn't make sense. It's a investment calculation at the end of the day you're doing, and taxes is one part. It might be significant to some, but at the end of the day, the economic part, I think, is the relevant. How is the market? How are the markets developing? And I mean, you see comparable cases in Germany where we had just the subsidies for Eastern German properties, residential properties, because you have a huge depreciation incentive. So people bought these houses and at the end of the day, they could not sell it. And they ended up in a full loss of that invested capital in some cases. So that's exactly the point where you're just selling a tax advantage, which is limited time-wise, or if you're just acquiring a property or an asset, which may increase in value. But that's basically something I think is essential in any investment decision, just to see the overall picture.
Yeah, it is. It is. And it's interesting. So I use the term hyperlocal. So real estate is hyperlocal. So anywhere you go in the world, anywhere in this country or any country in the world, it really comes down to the area, the block, and the positioning on the street in that block. You know, when you're looking at the base asset level of making those decisions, it's really interesting. You know, how that transfers all across the world. You know, real estate's real estate no matter where you are, right? It's all about location.
That's true.
Yeah, and it's all about the deal. So what I tell a lot of people is that I advise, watch the institutional capital. And the reason I say that, and I tell people watch where they're putting their money, is because they spend a lot of money on intelligence. They do a lot of market research, they do a lot of market studies, and they kind of can know where the trends are going. So I know you advise a lot of institutional clients. Where are you seeing the capital flow right now?
Well, I think in the institutional sector, there's still currently a focus on I think the European countries. However, there's a strong appetite also for the Asian markets. So this is still under development. And as I said, there are to some extent regulatory reasons why there is not such a significant amount. But I mean, if you see where do you have the opportunities, where do you have really higher yields on the rents, higher yields on the capital gains, and then you need to really leave your country or your home domiciliation and see where you have opportunities. So what I've advised in the past years was also on Australia, where we really found that there are a lot of Asian investors investing currently, and also to some extent, say, the saturated Asian markets. I mean, if you just look at China mainland or Japan, this is still fine. So Vietnam, for example, is still something where it's more hazardous to invest at least from a conservative German institutional investment. But you're completely right. All these institutional investors, they have their own investment advisory committee. They have their own strategies, which countries to invest at what point, in which time frame. And they just consider the whole economy. It's not only the property, but they say, well, how's the economy as a whole developing? Where do we have opportunities? Where's the center? How's the infrastructure? And that's basically more from a macroeconomic perspective, what you need to consider. And then it's right. So at least for individual investors, I've seen a number of institutional funds which really enabled the private investments into such really large institutional portfolios, which were, of course, then able to participate in this know-how and this experience in the management and also in the selection of well-suitable properties. But as to the markets, I mean, I think United States at present, I would say it depends on the appetite and also on the risk profile, whether or not the United States will be a good point to invest right now. So as I said, I'm more limited taxes, also unfortunately not too macroeconomic, but I would say this is something which we need to monitor in future, of course, because there will be a hype again. And so it's the question to hit the right point, when to invest in the United States again and where to invest in other countries.
Yeah, we are reaching the ceiling in the United States for assets, the pricing on assets right now. It's really hard. Price discovery is really difficult right now. You know, money is very cheap, free flowing. So we have a lot of artificial capital in the system right now that's propping things up and that's increasing asset valuation. So I think there's a little bit of pain coming in all of the markets here in the United States at some point. Again, I think we're okay through the end of the year, but going into next year, depending on what happens, you know, we could see some real deflation in assets all across the board, the markets, real estate, you know, pretty much everything. And it's largely related to the interest rates. And in this country, we have nowhere but up to go when it comes to interest rates. And when that happens, if we do see real inflation at the retail level, on the Main Street level, which we're not really seeing right now, it's only at the asset level, that's when we could see interest rates potentially increasing, that would really cause some serious damage in this country.
That would be true. How do you see, just one question back, how do you see the appetite from the United States to invest, for example, in Europe? Is there a reluctancy currently, or do you see any development markets as well, just from the United States perspective?
Yeah, most of the United States investors that invest abroad are looking mostly for emerging markets. You know, same kind of thing. They're more opportunistic. In general, I think that from a residential standpoint, you know, there aren't as attractive opportunities outside of this country because the assets are a little bit different. But in general, when you get into the office, retail, industrial, mining, you know, all kinds of other different assets, you know, there is a lot of appetite. I think, you know, Blackstone's putting a bunch of money in Brazil. They're really bullish on Brazil. You know, other countries, I think, you know, probably some Asian countries where you're seeing some emergence there. And then there's, you know, certain countries where they just can't even touch it. You know, Canada is very expensive. You know, we get a lot of Canadian investors coming to the United States. We get a lot of Australians looking at the United States, interestingly enough, especially in the multifamily sector. But I think for the U.S. investors abroad, it's an opportunistic approach. Yeah. Well, great. Well, Martina, I appreciate you joining me today. I enjoyed the conversation as always. And, you know, hopefully we can do this again sometime.
Yeah, I'll be. Thanks. It was a pleasure for me as well. Thank you, Greg.
Yeah, it was great to see you.
Thank you. Thanks.